today I'm going to talk everyone through to how to buy a business using commercial lending. So a bit of an agenda. First of all, we're going to talk about the why. Why do you want to go and buy a business? First of all, if you're a new business owner or an existing business owner. Second thing, we're going to talk about how to fund that acquisition. We're then going to go through a couple of bits of the standard gearing ratios that banks and non-banks look at. So the why. Why do you want to go and buy a business if you're a new owner? There's three predominant reasons. The first one is risk reduction. So if you've just finished university or you're in a corporate business and you've decided, right, I want to go out and do something on my own. There's two ways you can go. You can either go and start your own business. I'm sure many of us in the room have done that. The second way to go is to actually acquire a business. The stats on the board that 70% of new businesses, startup businesses fail. That's because it's hard. It's hard to find new clients, find the data, find your service offering, where's your supply channels coming from. And if you buy a business, that's already set in place for you. So you can then just utilize the current assets in the business, improve and extend from there. The second main reason is, as on the board, no one's made a dollar working for someone else. Equity is everything. Equity equals dividends, dividends equals profit. You look at the top 100, in the Forbes list of the top 100 richest people in Australia, there's only one person who's an employee of a company, and that person's at Macquarie Bank. She's the CEO and she's made all her money in equity. The final reason is freedom, corporate lifestyle against the small business lifestyle. I think everyone can tell you horror stories of corporate hierarchy. You get stuck in the political chain of a corporate business. As a small business owner, you don't have to worry about that. You control your own destiny. Obviously, you've got a number of other problems, but they're the three main reasons why people go out on their own. For existing business owners, there's three main reasons people go and acquire a business. One is growth. There's three ways to impact the value of your firm. One is growth, one is increasing return of invested capital, and the final one is the weighted average cost of your capital. Those are the three only ways to increase your value of your firm. So one of it's ego. The second one is actually risk reduction. And what I mean by risk reduction, and it's probably not what you think, is you've got your current business and each year it's going to spit out, whatever it spits out. $100,000, $200,000, $1 million. If you go and double that in value, what happens is that your discount factor actually goes down. So when someone's looking to buy your business, they will look at your cash flows from now to the future, to infinity actually, and they'll say with some degree of certainty, this is what I can discount that cash flow by. If you are larger in size, the discount factor is actually less. So you actually, without actually doing anything, you can increase the value of your firm and reduce the risk for people trying to buy your business. So what I mean by that is if I have four businesses, exact same cash flow, and I put them together, I can buy them all for, call it 1 to 4 times earnings in that small business category. But if I put them all together, I can instantly sell them for 5 to 6 times earnings. Without doing anything, exact same businesses, exact same cash flow, and I've just made, put another 2 to 3 times multiple on that business, and some, to be honest. So that's the second main reason. The final main reason is to acquire individual assets. It might be technology, it might be data, it might be a client base, it might be a new service stream, it might be a new industry or a new jurisdiction. You might be going to Queensland if you're currently based in Sydney or Newcastle. So you might go and acquire individual assets where you're looking to actually just acquire items on the balance sheet. All right, so now we get into the how. And we'll hear from the King, Warren Buffett. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price. So first of all, you've got to identify your targets. And the strong recommendation is you want to have lots of heads of agreement out with potential companies. That's where the owner is interested in selling, you're interested in buying, you've agreed to some high-level terms, and then you're moving to DD. The reason I say you want to have lots out and not just one out is that you can sometimes get into deal fever where you need to purchase that business. It's happened to a friend of mine. He got white line fever where he'd been looking for so long. He purchased a business and it's gone badly. Clients vanished, supply channels weren't there, and he's had to work his way through that, and he has worked his way through that. So really, don't get white line fever. Have lots out there, and when you're ready to make the move, then you go ahead with it. Pay an expert to do the due diligence for you. You heard from Peter how he goes in and will do that due diligence for you. Pay someone to tell you why you shouldn't buy the business is very important as well. So identify your target price. Where do you want to be paying? Usually it's a multiple of cash flow, usually EBITDA, and sometimes it's a multiple of revenue. I've had a friend sell his business for 15 times revenue. Nothing to do with profit or EBITDA, revenue. Sometimes it's book value to assets. You know, Warren Buffett bought Berkshire Hathaway on book value. He was just buying an old textile mill, but he saw that there was shed loads of assets on the balance sheet that he could then sell off and create cash out of to then go and invest further. Identify a target capital structure. So this is really important. There's two ways to fund the business. You either use debt or equity or a combination of both. You want to understand what's your ideal capital structure. First of all, on day one, and then also in 2 years' time. You really want to be at that 2 times EBITDA multiple. And if you're not there, you want to have a strong path to that 2 times multiple in 1 to 2 years' time. And the reason being is because any lender will generally put constraints on you. They'll want you to pay down debt. And paying down debt is usually a strong leakage of capital. So it's you ideally want to have a path to this 2 times. And then how are you going to fund your working capital? The last thing you want to be doing is buying a business and then all of a sudden realizing actually I've got to spend another $1 million on inventory, or got to go and pay out this person who's I've got all these leave entitlements for. So really important how you're going to fund your working capital. Then moving into your approvals and final signatures and settlement. Making sure that on day one, you've covered off all your operational risk to manage that business. And obviously any lender is going to want to see a pretty thorough plan about how you're going to execute, the sort of synergies you think you're going to bring, and then from there how you're going to grow into your desired pathway, using those hockey stick projections. All right, so just moving on to some key data. You've got the banks, the big banks. The cheapest cost of capital in Australia is with the big banks, the big 4 banks. They've got everyone's deposits in Australia. That means they've got the cheapest cost of debt. So usually if you're not with the big banks, there's got to be a reason why, and it's usually if you're moving outside for a particular reason. Typically the leverage ratios the big banks like to see is 1 to 2 times. They max out at 2 times. They can sometimes get a bit skittish even at the 2 times. Non-banks, they're willing to move to that 3 times, 2 to 3 times leverage. That's debt to EBITDA. Asset lenders, banks will not lend on an asset. What I mean by that is if I say to a bank, here's $10 million worth of cars or $1 million worth of cars, will you give me money against that? They will say, no, show me the cash flows. Whereas non-banks or any asset-based lenders will do that. They'll say, okay, I can see there's a property worth $1 million, I'll lend you 500 grand against that. So they will lend just on an asset without any cash flow. But they'll want to see an exit. So if that's your scenario. Skin in the game, banks want to see you have a bit of sweat in there. They want to see that you're contributing, usually up to 50% of the purchase price. Non-banks are quite commercial. They don't really care as long as you've got the cash flows to support the obligation and that they can see a pathway to exit. They're comfortable. Debt servicing coverage ratio. What I mean by that is based off whatever your principal and interest repayments are. Let's say if you've got $100 of principal and interest, you might have an interest-only period, but after time they'll want to see $125 to pay back 100. So 1.25 is the minimum. Non-banks are a lot more flexible as long as there's a 1 times or a pathway to this. And then rates, you're looking at that 5 to 8% for banks. Obviously the 5s, if you're a very strong business, you're able to exhibit those items that I was speaking about, strong cash flows, good asset, a lot larger in size. The non-banks, you're playing in that 10 to 15% space. They're almost quasi-equity. They're stepping in where equity would usually be. Banking covenants, often banks will like to have covenant tied, quarterly covenant testing, a covenant tied to your balance sheet. Usually they want to see you retain earnings. They don't want to see you paying out all your earnings as dividends. And the second one being something tied to your profit and loss. So usually an interest coverage ratio, something along the lines of, how's your profit and loss been this year? This leverage ratio for banks, they will go outside that, particularly for specialised industries. So accountants they love, private wealth, rent rolls, any service-based businesses they love. So a couple of quick examples. First of one, this one's an active lend at the moment. It's an existing group, hospitality business. They're acquiring another high energy venue, fancy word for a nightclub, at 4 times EBITDA, Brisbane based. They're doing this with 100% debt funding. So they're using the existing cash flows and assets in their business to acquire another complementary business at a 2 times EBITDA. They can show synergies, the numbers stack up. They're looking for non-recourse into directors. There's leasehold, so there's no real property security. And there's a tax payment plan from a prior small business review. And we're really targeting private lenders due to the SBR and the non-recourse nature. Here's another example of a new entrant. This individual is a corporate, working at a corporate. He's buying a business, a small business. It's a small retail business. And he's buying the management in place. He's buying the supply channels, the client base, and he is really looking to exit his corporate career at the moment. He's got to do a lot of normalisation. He's seeking 100% debt funding. And we got him terms without putting his house on the line. And we gave him terms with house on the line. He can reduce his rate by 4%, circa, with his house on the line. So we're going with the Big Four bank. In conclusion, just some closing thoughts. There's about 500,000 businesses in Australia that are going to retire in the next 10 years. They're going to need an exit somehow, and a very prominent way is to sell. So acquisitions can be very, very value accretive for you and your businesses, and it's been proven time and again they can be winners. Having a really good team and ensuring your due diligence is done properly and well, and you don't get white line fever and this deal-hungry scenario is very important. Have lots of balls in play, make sure you've done the due diligence and you're very thorough with your analysis to execute. So make sure you've got a good team. If anyone has any scenarios want to discuss, very high level, I'm always happy to chat. So thank you for your time.